Hello friends, have you ever noticed that while analyzing a chart, the market is moving in a strong uptrend, with price continuously making bullish candles? Then suddenly, a large bullish candle appears with volume that is much higher than average. Most traders immediately assume that institutions or big players are aggressively buying, so without waiting for any further confirmation, they jump into a buy trade. But the real problem begins when, right after entering the trade, the market reverses instead of moving higher, and the price starts falling sharply. As a result, what looked like a perfect entry ends up becoming a losing trade. So the question is, if the bullish candle was strong and the volume was extremely high, why did the trade fail? Does high volume always mean buying? Or is there something hidden behind volume that most traders simply don't understand? In today's video, we'll learn everything about volume in detail. We'll understand how to analyze volume, how to combine it with price, and how to use volume to identify high-probability trading setups. So let's get started. First of all, let's understand what volume actually is. In simple terms, volume represents the total number of buying and selling transactions completed during a specific period of time. For example, if you're looking at a 1-hour chart and a large number of trades are executed during that 1-hour candle, you'll notice big volume bars below the chart. This indicates high volume. On the other hand, if only a few trades are executed during that hour, the volume bars will be much smaller, which indicates low volume. To add volume to your TradingView chart, simply open the indicator section, search for volume, and apply it. That's it, volume will appear on your chart. The green and red vertical bars that appear below the chart are the volume bars. The market never moves without a reason. Behind every price movement lies the strength of buyers and sellers. And the simplest and most effective tool to measure that strength is volume. That's why professional traders never analyze candlesticks alone. They always analyze price together with volume. With the help of volume, you can measure the strength of a trend and even get clues about when that trend might reverse. To do that, you need to analyze price and volume together. In trading, this relationship is commonly known as volume divergence. There are 4 basic types of volume divergence. The first is a strong uptrend. When price continues making higher highs and, at the same time, volume keeps increasing, it means buyers are still willing to buy even at higher prices. This indicates a healthy and strong uptrend, and during such conditions, we should mainly look for buying opportunities. The second type is a weak uptrend. Here, price continues moving higher, but instead of increasing, volume starts declining. This tells us that fewer new buyers are entering the market, and the bullish trend is gradually losing strength. From this point, the market may either move sideways or eventually reverse to the downside. The third type is a strong downtrend. When price keeps falling and volume continues increasing, it shows that sellers are still aggressively selling even at lower prices. This indicates strong selling pressure, and during such conditions, we should focus on finding selling opportunities. The fourth and final type is a weak downtrend. Here, price continues falling, but volume gradually decreases. This means traders are no longer interested in selling at lower prices. Such a weak downtrend can eventually reverse into an uptrend or enter a sideways consolidation phase. Now, here's something very important. Volume should always be used as a confirmation tool with other trading concepts. Let me explain this with 4 practical examples that you can even use as trading strategies. The first is pullback with volume. When the market is in an uptrend, we often wait for a pullback so we can enter at a better price. However, sometimes after the pullback, instead of continuing higher, the market reverses and hits our stop loss. So how can we identify whether it's a genuine pullback or the beginning of a reversal? This is where volume divergence becomes useful. When the market is moving upward and starts pulling back, pay close attention to the volume bars. If volume continues decreasing during the pullback, it indicates that sellers are weak and there isn't much selling pressure in the market. This represents a weak downtrend in terms of volume divergence. It suggests that the pullback is likely to be genuine. Once price reaches a strong support or demand zone and forms a bullish reversal candlestick, you can consider entering a buy trade. The second example is reversal with volume. Imagine there's a key resistance level from where price previously made a strong bearish move. If price returns to that resistance with a weak rally, where you don't see any strong imbalance or momentum, It suggests that buyers are losing strength while sellers remain strong. Now, if price touches the resistance and forms a bearish reversal candlestick with volume significantly higher than average, it confirms that sellers have become active at that level. With this high volume confirmation, you can consider entering a sell trade because the probability of the market moving lower becomes much higher. The third example is breakout with volume. Suppose there's a strong resistance level on the chart. Price approaches that resistance with small-bodied candles. Then suddenly a large bullish candle breaks above the resistance, and the breakout candle is accompanied by exceptionally high volume. This is generally considered a genuine breakout because the combination of a strong breakout candle and high volume suggests that buying pressure has increased significantly and institutions or smart money may be participating. As a result, sellers become weaker, increasing the chances of a successful breakout. In this situation, you can either enter immediately after the breakout candle closes or wait for a small retest before planning your buy trade. The fourth example is avoiding traps with volume. Imagine price rallies aggressively towards an important resistance level, creating strong imbalances along the way. Once price reaches the resistance, another large bullish candle breaks above the level with extremely high volume. Seeing this, many retail traders experience FOMO. They believe that such a powerful breakout with huge volume means the market is about to rally much higher, so they start buying aggressively. But instead of continuing higher, the market suddenly crashes. Why does this happen? Because sometimes this is a trap created by smart money or institutional traders to book profits. Large players who accumulated positions at lower prices need buyers to sell their holdings. So they trigger a fake breakout, attract retail buyers, and then sell their positions into that buying pressure before exiting the market. That's why you should never buy a high-volume breakout purely because of FOMO. Instead, wait for confirmation. If the next candle forms a bearish reversal pattern, such as a shooting star, or if price closes back below the key level, you can then consider a sell trade. So, today you learned that volume is not just a few bars below your chart. It represents the real participation taking place inside the market. Always remember, price tells you where the market is going, but volume tells you whether that move is backed by real strength or is simply a temporary move. If you found this video helpful, don't forget to like it, subscribe to the channel, and let me know in the comments which trading topic you'd like me to cover next. I'll see you in the next video. Thanks for watching.